Right now, commercial real estate markets around the world are navigating steep macroeconomic headwinds. Borrowing costs are elevated, property valuations are under pressure, and lenders are generally backing away from large-scale commercial space. Against this cautious backdrop, South Africa's largest listed real estate investment trust, Growthpoint Properties, recently went to the bond market. Their goal was modest: raise a routine round of debt, targeting between 1 billion and 1.5 billion rand. This chart captures the massive oversubscription that actually happened. Growthpoint expected to cap out at 1.5 billion. Instead, institutional investors flooded the auction, arriving with total orders exceeding 6.5 billion rand. That kind of volume forces a very specific question. Why is there so much desperate pent-up demand to lend cash to a regional property developer while the broader global property market is contracting? This staggering volume of capital moving directly toward a single corporate landlord contradicts standard market caution. It points to a psychological shift in how large institutions are deploying their cash right now. To understand the behavior, we have to look at an economic concept known as the flight to quality. This is a highly predictable cycle that happens whenever broader economic conditions start feeling uncertain. Massive pools of institutional capital, think national pension funds and large asset managers, cannot simply leave their money sitting in cash. When they sense turbulence in global markets, they adopt a defensive posture. Instead of chasing high-risk equities that might lose value, these managers actively hunt for safe, income-generating debt instruments. They want fixed-income bonds attached to reliable, tangible assets. Those institutional managers didn't offer 6.5 billion rand out of blind enthusiasm for real estate. They looked at the market and identified Growthpoint's debt as the ultimate financial safe harbor for their anxious capital. Growthpoint capitalized on that immense demand by upsizing their final issuance, taking home 1.8 billion rand. This capital was secured through senior unsecured bonds, which means the debt ranks highly in the company's capital structure for repayment, even though it isn't tied to one specific piece of collateral. Growthpoint engineered a diversified maturity profile with 3 tiers of notes: 3-year, 5-year, and 7-year durations. A fluctuating line, the South African Rand Overnight Index Average Curve, determines their price. 3-year notes provide near-term liquidity, while 5- and 7-year notes lock in long-term stability. The entire mechanical architecture of this bond was custom engineered to perfectly match the exact risk appetite and timeline requirements of institutional lenders. All of that financial engineering only works because of the physical reality on the ground. Growthpoint operates at a vast scale as a commercial landlord. Their geographical footprint runs deep across South Africa's primary economic hubs, supported by strategic exposure in selected international markets. This breakdown illustrates their physical assets. They don't just own office buildings. Their portfolio is divided across logistics centers, retail spaces, corporate offices, and specialist property segments. This extreme diversification across different sectors is what guarantees their cash flow stability. If office rentals slow down, high occupancy in logistics and retail keeps the revenue steady, immunizing the company against isolated market shocks. The 1.8 billion rand financial windfall was ultimately earned through the physical resilience of the buildings themselves and the disciplined management keeping them occupied. This individual success at Growthpoint reflects a broader pattern appearing across South Africa's listed property sector. The market is entering a phase of renewed funding efficiency. We are seeing companies move away from simple survival mode and aggressively pursue opportunistic balance sheet optimization. Across the sector, maturing debt cycles are colliding with stabilized interest rate expectations. This has triggered a surge in REITs using bond markets to replace aging loans with more favorable long-term funding. While global commercial debt markets remain tight, investor appetite for South African property-backed fixed income remains high. REITs with strong credit profiles are currently locking in these conditions to secure their financial futures. Growthpoint's oversubscribed auction serves as the definitive signal that this refinancing wave is gaining momentum across the entire large-cap property market. For investors watching South Africa, this structural shift dictates the future rules of property investing. Direct access to deep institutional liquidity has become the defining competitive moat of the industry. Companies possessing strong balance sheets will capture a disproportionate share of this incoming institutional cash. As credit spreads tighten, these firms secure cheaper capital, allowing them to expand and upgrade far faster than their cash-strapped rivals. This ruthless dynamic regarding who gets cheap debt and who doesn't will separate the industry's winners from its losers in the upcoming market cycle. In the modern era of real estate, the ability to command institutional trust is as critical as the physical assets themselves.